Hi everyone, welcome to YX Insights. Today we're going to do a quick macro update as well as all of the Magnificent 7 stocks, primarily through the lens of liquidity, valuation, and price technicals. So let's begin. So we measure the Fed liquidity through the Fed's balance sheet, the Treasury General Account, the reverse repo program, and the previous bank term funding program. So what we have seen since the new year is that the Fed liquidity has actually turned up, primarily driven by lower Treasury General Account balances. So what does that mean? So the Treasury parks its cash with the Fed. So that, and you can think of that as the Treasury's own bank account at the Fed. And there's money coming in when the Treasury issues debt, and there's money going out when the Treasury spends it down. And so at the moment, the Treasury is in the spending mode. The money is flowing out of the Treasury general account, which is with the Fed, into the real economy and bank reserves. And on the margin, that is supportive of lower yields and looser financial conditions. So that's extra liquidity coming to the system. And we have seen that the 10-year bond yield has steadily declined since the beginning of the year. And what we observe is that so the 10-year has gone down from 4.8 into 4.3. So there's a lot of talks about growth scarce, tariff issues, potentially we're entering the recession, but actually a lot of that is being helped by first a benign conditions through the Fed liquidity over here, as we've seen the red line. So if the red line goes up, that's better for yields to come down. Secondly, the Doge effort of cutting government spending and having a realistic chance of reducing the deficit has actually reduced the investors' anxiety over the Treasury supply issue. And you can visualize that through a declining term premium on the 10-year bond yields. So about 30 basis points of this drop. So the 10-year Treasury yield has dropped by about 50 to 60 basis points, and half of that, or even more than half of that, is from the term premium reduction alone. So from 80 basis point to 50 basis point of term premium demanded on the 10-year. And the remaining 20 to 30 basis point is from an expectation of one more Fed cuts over the base case of 2 cuts at the beginning of the year. So right now, the market expects 3 cuts for 2025 as opposed to 2 cuts. What I think is that 2 to 3 cuts is about right, because the Fed clearly projected that they could see the unemployment rate go up to 4.3% as the labor market normalizes. Right now it's 4.1%, and these things PCE will be something like 2.2 to 2.3% by the year end. And it's moving towards that way. So if we're moving towards that target, we should see the Fed essentially sticking to its dot plot of 2 cuts, right? So the problem is that now we have this GDP concern where Cleveland Fed's GDP now is projecting a negative growth quarter for Q1. And what we saw in 2019 is that the Fed preemptively cut rates after the hiking cycle in 2018 because of tariff concerns, essentially. So I think the market is projecting this sort of preemptiveness from the Fed during the ongoing tariff instability right now. So there is a chance for one more extra cut, which is almost like an insurance cut from the Fed this year. Just looking at the ETF flows. This week does feel like, oh my God, another week, another red week. Everything is, all the rally getting sold, and investors are in extreme fear territory amongst, the tariff recessionary talks. But if you look at the stock indices, SPY actually enjoyed a positive inflow in the past week. Its AUM up 1.1%. QQQ essentially was flat. So there was a little bit of outflow, but it's not significant. And IWM, Russell 2000 ETF, also saw a 1.68% inflow. So institutional players are actually coming back into those indices ETFs. On the bond side, there's continuing inflows across the curve. You see at the very short end, the S-Gov, which is the very short end Treasury bond ETF. And then, but as well as the long end, which is the TLH and TLT, the 10 to 20 year and 20 year plus Treasury ETFs. So there's still great investor appetite to own bonds at those levels. And that sort of is backed by our liquidity chart from the previous slide to show that I think overall environment is supportive of higher bond prices and lower yields. And I think the current administration is really targeting the 10-year bond yield below 4%, essentially. And finally, in the crypto world, we have slight outflows in IBIT and the GBTC. So IBIT is the BlackRock, is the biggest one. It's the BlackRock Bitcoin ETF, and GBTC is a bit of the OG of the ETFs. And you can see investors from the smaller Bitcoin ETFs have essentially been getting out. We see large percentage changes in the outflows as a percentage of AUM in all those other big crypto ETFs. So overall, the crypto land is still in a risk-off mode, but investor sentiment is probably stabilizing for equity ETFs and, as usual, being supportive of the bond ETFs. What we have seen is that equities and bonds, so QQQ's SPY correlation with the 10-year Treasury yields essentially have returned from a negative relationship into the positive territory. What this means is that when bond yields go up, equities also go up, and when bond yields go down, equities also fell, which is kind of what we saw in the past month. So bond yields have been declining upon growth concerns, and equities also rolled over. But I would warn that at 0.2 is quite a neutral territory. So we're in a positive relationship, but that's kind of like very weakly linked at the moment. This is SPY QQQ IWM next 12-month PE ratio. So we have seen that in the past year, these are the bands. So the middle band is the median, the top band is 2 standard deviation, and the bottom band is the negative 2 standard deviation of where the valuations moved in the past year. What we have seen is that SPY, QQQ, and IWM are all approaching, if not already breached, in the case of QQQ, the negative 2 standard deviations from the past year. So the last time we saw those levels was really the August crash. And that proved to be an extremely good buying opportunity. That was a major pivot last year after the carry trade unwound. I think right now the valuation is becoming much more normalized, I would say, compared to historical levels after this big correction. So investors who were afraid of chasing high valuations at the beginning of the year should be more enticed to enter the market at those levels. And if we just broaden out to a 3-year look back, the QQQ is trading below its median 3-year valuation. So back to the level of 2022 and beginning of 2023. As we know, these periods provided the beginning of the bull market, of the current bull market. SPY is just above its median, but is not really in the expensive territory anymore, looking at the past 3 years. And you can say the same about IWM. So from my perspective, I don't think valuation should be cited as a major concern at this moment. It might be 2 months ago, but I think just watching how things have rapidly moved, I would say that investors shouldn't be citing it as a factor for sell-off anymore, at least. So for Tesla, we have seen a valuation is pretty much not really a factor for Tesla. Why? Because Tesla doesn't trade on its company fundamentals, existing fundamentals, that is. Tesla is basically trading on two sources. First, investor sentiment towards Elon Musk's vision for the robotaxi, which is a multi-trillion-dollar market, and a humanoid robot, which is Optimus, and that's also a multi-trillion market. So Tesla trades based on the future vision of what it could potentially achieve by 2030, rather than where it is now. So I do think this PE ratio is pretty meaningless at this moment. And the second factor is that Tesla trades against the global liquidity moves. So we'll see in a second. So this is the M2 money supply at the top for G5 countries. The G5 includes the US, UK, China, EU, and Japan. And we've seen the money supply going up in Q3 last year. And Tesla essentially has about a 11 to 12 week lag, just like Bitcoin, actually. And we see the move of Tesla moving essentially in the same direction as the M2 money supply with the 11 to 12 week lag and topping over here. So right now, because of the strong dollar at the back end of last year, we saw that the M2 money supply contracted in dollar amounts. And that has been a headwind for major risk assets. That's been still felt today. So Tesla has declined from its in a rapid fashion from the December high, but actually that is essentially driven by the reduction in the contraction of the M2 money supply in dollar terms. So the strong dollar has made an impact on Tesla with the lag. However, this pain may only last just 2 more weeks. Essentially, since the beginning of the year, we have seen the money supply expanding again because of the weaker dollar. So dollar went down, the denominated measure of money supply has gone up globally. So I do expect Tesla to make a comeback starting from essentially April, but the next 2 weeks are getting quite uncertain in terms of whether we're seeing immediate bounce now or we're just going to see a sort of sideways action to form a bottom. So I have seen people saying, oh, they want to short the market until 200, or they should dump the Tesla holding now and buy back when it's lower. But my question is, the stock has plunged 50% now. Why are you shorting it now? As I think shorting it here is as unattractive in terms of risk reward as buying it when it was reaching 450. Essentially, I think that's the two sides of the same coin. It's a bit of FOMO on the way up as well as on the way down. The first thing I want to point out is the RSI levels. So we reached RSI of just below 20 on Monday. And historically speaking, since 2019, we had 4 occasions of this happening. And each of the 4, except for the 2024 occasion, which I'll talk about in a second, proved to be a major bottom for Tesla. So after it reaching below, the RSI reaching below 20, we had really sharp rallies in the subsequent month, essentially. And even in the case of 2022, the stock actually nearly tripled within 1 year. So it does feel like right now we're much closer to the end of the job. In the case of 2024, what we had is that the RSI did breach 21st, and then that we saw a bounce, and then another 20% down. So 10% bounce, and then another 20% down from this bottom here. But that was supported by rising lows in the RSI. So that's a positive divergence. And what we saw was that the stock then doubled in the next year into the essentially the December high last year. So we could see a similar pattern where we have a bounce here and then grind lower. We don't. I mean, nobody can really tell you whether that's going to happen, but I can be quite comfortable that we're much closer to the bottom here. And I do think going from April to May, we should see a much warmer sentiment. And people will start talking about the new Model Y being a hit, or the robo-taxi plans for June, people getting excited. But that's really just news headlines and narratives driven by the stock price reaction instead. And just looking at this 5 waves here for Tesla, it looks like an ending diagonal where wave 4 overlaps with 1. What this means is that as opposed to the impulsive wave where this wave 5 could be much higher above 1,000, now it's most likely to be somewhere in the 700 handle, which is still not bad for compared to where we're now. But that just means if you bought near the top here at wave 3, the risk reward, the reward is not really that great compared to the risk of this drawdown. And we're seeing wave 4 essentially stabilizing at a 0.618 retrace of wave 3. And that could go down as much as 0.786, like I said. But I do think we are towards the end of this sell-off, essentially. So what we really want to do is just zoom in a little bit. We want to see a 5-wave rally from here. Taking shape, that gets above 300. So we want to see this pattern first to confirm that this is the bottom. NVIDIA is trading at 26 times PE, and that is the cheapest level we've seen all year. And its earnings is actually rising rapidly. So I don't think the stock is dead. I think there's one more high to be made. We're nowhere near the end of the AI cycle. It doesn't mean that NVIDIA will just go up forever. It depends on the competition and the demand for NVIDIA's GPU and the wider supply of GPUs out there. But the inference market should be much, much bigger for real-life applications than the training side of things. Or the large language models. So I still think we are probably only halfway, if that, in the AI cycle, and NVIDIA shouldn't be out as a stock. But I think there is great confusion from investors who just generally don't know how to value NVIDIA because it is a cyclical stock dependent on the AI cycle, AI demand. But also, a lot of investors have bought NVIDIA simply because it's gone up a lot. So now they're out because it's gone down a lot as well. So that's just pure sentimentally driven. Just looking at the price technicals, I also think this is a ending diagonal where you have wave 4 overlapping with wave 1. And we made 5 waves up for wave 3. There's a very short wave 5. And then wave 3 waves down for wave 4. And essentially, this wave C is trading at a 100% extension of wave A. And we've seen a bounce here. That does suggest to me we likely have bottomed, but this has been a very tricky stock to trade. So I would want to see it building a sustained momentum here with a 1, 2, 3, 4, 5 waves up from this low to confirm the bottom. That does mean we're trading away potential gains for greater certainty. From here, if one wants to attempt a high risk reward bet and have a stop near the 100 mark, which is wave 2 low, So I do think that could be, if you for disciplined traders, that could be a good swing trade, having this as a stop. Looking at Meta has not breached its August 5th low yet in terms of valuation, but it has corrected a lot. So the PE ratio reached above the 2 standard deviation essentially after the inauguration. It basically printed 20 consecutive green candles, and now it's corrected below its medium trading area. And technically speaking, I do think we've had this correction over where wave C is equal length to wave A. I mean, it could stretch towards 570. That would be the 1.236 extension of wave A. But I do think most of the damage is down. It's done here. We could be contemplating a trade setup once we see essentially the market warming back up in terms of risk sentiment. Amazon again is trading at its negative 2 standard deviations of its past 1 year valuation range, P at 30, and that's below the August 5th low, which proved to be a very good buying opportunity. So from a technical point of view, initially I did think this might be 1, 2, 3, 4, 5 here. But just looking at the extension, I don't think that was the right proportion. It looks much better as a ABC down here, very much like Meta in the previous chart. And given where the valuation is and where the RSI is, I think we're close to the bottom. And I'm just really watching for this wave C to get to this 184 region, which is the 100% extension of wave A. So once it reaches there, I'm comfortable of having a trade setup. And if you just look at where we traded from this August 5th low, which is the last time valuation reached this pessimistic level, essentially we moved from 150 to 240. That is a pretty nice rally in the space of just 8 months or so. So after this wave 4 correction, I do think we will head back towards 250 plus. And the way I see it is that, let's say if we end wave 4 here, so wave 5 typically trades at 1.382 to 1.618 extension of the wave 4, so the inverse of wave 4. So that's where I have my target. So 250 above, around 270 region. And I actually think in terms of the valuation for cloud AWS versus the rest of it, if we use growth adjusted multiple for the two different parts of the business, I can see something like 270 being the fair value for Amazon. And so we're trading quite significantly below it. I had more of that in my newsletter right up on Amazon earnings. So for Google, again, Google's valuation has approached its negative 2 standard deviation, the August 5th level as well. And one thing I do notice is that Google trades much more positively with the 10-year bond yield than the rest of the cohort. So it's trading at 0.5 correlation at the moment. So it's pretty much moving in line with the yields. However, if you look at the historical levels, that's kind of like the upper ceiling of where it's been. So this 0.5 level of correlation is basically a turning point. So the correlation starts to move towards negative territory after it reaches this level. So I think from here onwards, it could trade with the yield positively for a while, but looking slightly further out, I do see it mean reverting, where lower yields could provide Google to go up actually rather than down. just looking at these technicals, I have this as wave a very short wave B, and now potentially wave C completing above 160. Google has been quite difficult to analyze because if you look at the chart pattern, it's not really very clear 5-wave sub in the way, and there's always a lot of investor uncertainty around the antitrust issues and it being involved in the retaliation of China against tariffs. So there's a lot of regulatory and geopolitical risk for Google. Having said that, in this region, we've seen the highest trading profile around here, and technically we've had quite a big correction that doesn't look complete and valuation-wise is very comfortably low. So I do think it probably warrants a trade setup in the coming week. And if you just finally look at the RSI, we are essentially printing higher lows here against the lower low price. So that's a positive divergence. So I do see Google bouncing from those levels in the coming weeks. And I do think we've seen 5 out of the 7 Max 7s now. It does feel like the Max 7s should be having a rebound soon. And looking at Apple, again, Apple's PE has nosedived to 25x from 45x back in summer last year. Apple doesn't really trade on its fundamentals because it's not really growing as a company, and it's facing issues, regulatory issues in EU and China regarding its Apple Intelligence. I have Apple Intelligence on my phone. To be honest, it's not that amazing. I like the new device regardless, but I do think Apple is probably a later AI play because it's relying on the inference side of things, the applications people can build using AI rather than just the large language models, etc. So I think Apple should flourish in the second half of the cycle, being a AI carrier rather than an AI trainer. So, and also Apple does trade on share buybacks rather than its fundamentals, essentially. So there is still a lot of upside to be gained, despite its high valuation in the absolute terms, in terms of 25 PE, which is pretty unforgivable for a company that doesn't really grow earnings. So just looking at the stock now, we're essentially back to the August level last year. So the stock really hasn't moved that much, almost for a year now. And just looking at this wave C pullback is entered our target zone of 1 to 1.236 extension with a RSI also below, also trading at 26 now. So the stock does feel oversold in the short term. It can get down to 200, but I do think this wave of sell-off is probably near the end as well. So I have my wave C target essentially at 100% extension of wave A from this wave B low, where it might end, that points to 280-ish. And finally, Microsoft valuation. Again, Microsoft is not that loved by investors at the moment. PE has gone down to 27. To be fair, that's not that cheap still for given its growth rate, but it is definitely trading at 1 year low, way below its August 5th level and below the 2 standard deviations. So we're at oversold territory. Very much like Google is trading with 10-year yield at the moment, reaching a positive correlation of 0.44, and that's been kind of like the highs of the past year. So that correlation could start reversing. And I do see this wave C as a 5-wave leg, and we're now in the final wave 5. And I have wave 5 around 360 to 370 as a target, so just below the current level. There's not really a lot of volume profile trading at this level to support the price, so it could see a bit more free fall. And if you look at where it last traded here, that was in December 2023. So Microsoft hasn't really done anything in the past 1 year, despite its large capex, OpenAI, partnership, and huge AI investment. This is a very long consolidation period, and to me, that does look like a larger degree wave 4. And I do think there is a wave 5 coming up, eventually targeting the 600 level, but we will get there. We'll talk more about it once this wave 4 is complete. So that's it for today. Thank you for joining. If any questions, please ask me on Slack. So thank you.